So I'm speaking with Mike Semanco, President and COO of Hennessey Capital. Mike, what is Hennessey Capital?
Hennessey Capital is a commercial finance company. We provide working capital, lines of credit, and factoring of accounts receivable for, as we define it, post-revenue but pre-bankable companies. And what that means is companies that are in the marketplace that have sales, that sell to other businesses, for whatever reason, don't qualify for traditional bank
Clear with everybody. You talked about working capital finance. What is that exactly? What does that boil down to?
We define it as it's asset-based lending on the company's working capital assets, primarily accounts receivable and inventory. So what we do is we leverage those two asset classes as much as possible to give that client as much access to cash that they may need.
Why is it that these clients might not have access to a bank? Because we've spoken with banks who do exactly that same thing.
You know, a lot of times we run into companies that don't have the financial track record. It's not that they don't qualify from a collateral-based standpoint.
Right.
They just are too young. And that's why we define it as post-revenue. So a lot of companies we run into are less than 6 months old or 3 months old. They may be starting tomorrow putting salespeople on the street and getting new product out the door, but they don't have the financial track record to qualify. We look at it as, do they have the assets that can be leveraged, and then can they perform the services that really are behind that contract with their customer? And if that can happen, and we believe in the management team, that's a lendable transaction for us.
You do an analysis and you say they have the assets. So why can't the bank do that same analysis? What is it that you've got that the bank doesn't have?
I think part of it is the willingness to take on that early stage client from a risk profile standpoint. We tend to look at the future of that client's history versus the true history of the client, because we know the history is not always indicative of what the future is going to be.
Right.
So we try to project out with the client's help and obviously their management team as to how we can lend to the client today and then take them going forward with new opportunities.
Okay.
We don't have set formulas that we play with based upon that client's previous history. We start from today going forward.
Let me ask about cost of capital then for this kind of thing. Lower or higher than a bank?
Higher than a bank.
Okay.
And because we're taking a bit more risk in that transaction, obviously we need to price for the risk parameter. Our clients look at it as the ability to gain access to the capital they need to grow their business.
Right.
So a lot of our clients look at it as a cost percentage of their sales level.
Okay.
So if we feel that our formula or our cost of capital is too great for that company, we're not going to recommend that they move forward. We're the first ones to tell them that our cost of capital is too high for your base of business. You don't have the margins that can support the growth.
Right.
A lot of times
you're not in this to drive them out of business.
No, we're looking at, most of our clients come to us because they have growth opportunities. Either they're growing out of a very new situation or they're growing out of a previous problem that they've overcome and now they've hit in the stride to really grow forward. They're looking at it saying, how do I gain access to capital by using my current assets versus going out on the street trying to raise capital for my business, which is an alternative.
What are some insights then into that decision why an entrepreneur would go with you and your kind of debt financing versus equity financing?
I think a lot of times the entrepreneur looks at it saying, if I'm going to raise equity, I'm going to use that equity to further the development of my product or further development my marketing, or use that equity to build infrastructure so I can grow my business even further. Our financing is used to meet those day-to-day requirements.
So you're more tactical and taking on equity is more strategic?
More strategical, absolutely. And we've actually partnered with venture capital companies or angel investors where they will put their piece of business or layer of capital into a company, and then we'll come on top of it and we'll provide the daily working capital piece. Because a lot of venture capital and angel folks want the entrepreneurs to stand on their own.
Okay.
They want to be able to get a starting point for traditional bank financing. And they may not be there yet because they don't have the track record, but ultimately they will be, and they want to be able to stand on their own. We provide a level of capital that complements the traditional equity and subordinated debt piece within a company's capital structure.